Anyways, this is titled the 100-Year War to Serve Our Working Americans. And I'm going to talk about the beginnings of credit unions, the evolution over the last 100 years, and then banks and credit unions today, but also the relationship they had over the past. When you talk about 100-year wars, historians refer to the 100-year war between England and France, which took place between the 16th and 17th centuries. And then there's the 100-year war between the New York Yankees and the Boston Red Sox, which is near and dear to my heart because I'm a Red Sox fan. There's what historians today would say that World War I never really ended until the fall of communism in the 1990s, because one thing led to another. World War I led to World War II, and then the Great Cold War that we fought for so many years. And lastly is the 100-year war between banks and credit unions, as credit unions have sought to serve the American working class. And that's what the revolution was. So why does history matter? And I've talked about this in the past. It's context that is applicable today. That's the thing about history. History isn't just dates and people in the past. History is what we live today. And the relevance of the past is that there are threads that follow us from one generation to the next, and one thing leads to another. So what credit unions went through as they evolved and why they were created in the first place is as relevant today as it was in 1908 when the first credit union in the United States was founded. So we want to understand how and why credit unions evolved and why they're relevant. Understanding that banks have had a 100-year history opposing credit unions and fighting to eliminate them or to make them irrelevant. And that's what we see today, with particularly with the Don't Tax My Credit Union initiative that CUNA has created, as Congress looks at possibly rewriting the federal tax code, and they say they're starting with a blank slate. Everything's on the table, including the credit union tax exemption. If you remove the credit union tax exemption and you don't understand why it was there in the first place, then it's going to change the nature of credit unions. It's going to change their ability or make them unable to serve consumers the way they were designed to serve consumers. Knowing history and context creates ongoing support for credit unions in their mission today. So it's important to know what happened in the past and how we got to where we are now. And finally, knowing when to compromise and when to say no. There are Bismarck, the famous German prime minister, once said that making legislation is not a fun thing to watch. It's like making sausage being made. And what goes into sausage, we all know, isn't always the nicest stuff. But that's really true. I mean, what our government affairs staff does in D.C. and what they have to deal with on a regular basis as they negotiate with Congress, negotiate with senators and Congress people, and then their aides, it's important to know that along the way, you eventually end up making some compromises. And we have made some compromises in the past. Some of those compromises are now issues that credit unions want us to resolve today, and I'll get to that a little later. But you need to know when you have to compromise and when to say no. When the 13th Amendment was being debated in the mid-1860s, just prior to Lincoln's assassination, Thaddeus Stevens, in the film he was played by Tommy Lee Jones, was a radical abolitionist, radical Republican from Pennsylvania, a congressman, very, very much involved in getting the legislation, the 13th Amendment, through Congress. And when it finally did pass, there are elements that radicals wanted in the bill that really didn't make it into the bill. And someone asked Thaddeus Stevens, why would a man of your principles, why would he accept this? And Stevens simply said, because I live among men and not angels. Meaning that, we don't live in a perfect world. We always have to make some sacrifices and compromises. So I wanted to put this up here, this slide. This is from the 2009 or 2010 environmental scan. And I just want, as I talk about the history of credit unions and the way banks have reacted to credit unions over 100 years, it's important to see how this banking system has evolved in the last decade or two. And particularly since the 1990s, when the Glass-Steagall Act was dismantled, which came out of the Depression and limited what banks could do and had a clear dividing line between banks and insurance companies and investment companies and so on. What we've seen is a phenomenal consolidation of the banking industry to a point now where the greatest number of assets are controlled by the very largest banks, the Wells Fargos, the Citis, the Bank of Americas, JP Morgan. And why that's important is that when banks go to Congress and argue about credit unions, and credit unions shouldn't be allowed to do this, and they shouldn't be allowed to do that because they're a threat to the for-profit banking sector, the fact of the matter is, as I'll show later with some slides, the threat to the banking sector doesn't come from credit unions. When you look at what credit union market share is compared to what it's always been, it's pretty similar. I mean, there are different things you can measure, like first mortgages, and credit unions might have a larger share of first mortgages than they do of all depository assets. But still, the great threat to the community banking industry, which is where the associations, the banking association, truly trying to represent the bank's interests, the greatest threat doesn't come from credit unions. It comes from other banks. So keep this chart in mind. It kind of looks like the NCAA brackets as they're going through March Madness and Final Four. So when we talk about credit unions, there were two eras that really spurred the development of credit unions. And it's important to recognize that credit unions really are vehicles of reform. They just weren't an idea that one day sprang up and someone said, it'd be a great idea to create these little financial institutions and make them cooperatives and they can serve people. The fact of the matter is there are a number of socioeconomic and political trends that occurred at the end of starting really in the middle of the 19th century and continuing today that made credit unions necessary. So the two major trends that I want to talk about is the progressive era from 1890s and the 1920s, and then the New Deal and the recovery from the Great Depression. And when you look at the great American middle class and how it was formed, and the importance that that middle class was to American businesses and political stability in the United States, a lot of that came out of reforms that were made politically, social, economic reforms that came out of the progressive era and the New Deal recovery. The progressive era, today with the term progressive being a little bit more controversial and inflammatory, particularly for conservatives, progressive era at that time was a bipartisan initiative. There were Republicans, there were Democrats, and what they looked to do was to make some reforms that basically resolve some of the issues that were being created in society by some major trends. And I'll get to those here as we talk. The progressive era, you had three major trends at that time: industrialization, immigration, and urbanization. And industrialization is very important to realize because you had two industrial revolutions. The first one occurred earlier in the 19th century, and that led to small cottage industries, the mechanization of production. What's often used as an example is the clothing industry, or how people would make clothes. People generally made their clothes themselves in their own homes. And now you have these little cottage industries springing up where entrepreneurs would band weavers together and they would produce clothes for a business. That led to the Rochdale Cooperative Society of Pioneers, the first cooperative in the world, at least in the modern era, and the democratic principles that guided the Rochdale Cooperative are still the very same principles today that we use in credit unions. And Jill has done a great job in the last month or two tying our casual Fridays, our Jean days, in with learning more about cooperatives. So democratically controlled, one member, one vote, that type of thing. It was a different way of thinking of how to do business. So that was the early industrialization, the first industrial revolution. The second one that occurred late in the 19th century and into the 20th century really was the creation of massive capital-intensive businesses that were producing lots of products and services. And so that was one of the things that was important. And one of the things that happened with industrialization is you had people moving from agricultural communities, because the United States was primarily a nation of farmers. And 1920 was the first time that the U.S. Census Bureau reported that more people lived in cities than lived in rural environments. But you have to remember that they used the definition of city was 1,000 people or more. And that was the first time more people lived in the cities, and that was a small definition of cities, than lived on farms. So you had this movement of people out of rural communities, out of farm work, into cities to do factory work. And now they didn't really have assets anymore. Now they were earning wages. So that was a big part of it. Immigration, the early 1900s was an era of immigration that exceeds what we have today. When people talk today about U.S. immigration policies and illegal immigrants, legal immigrants, whatever it might be, fact of the matter is a percentage of the U.S. population, that particular era, there were more immigrants as a percentage of the U.S. population than there are today. And you had a great influx, particularly from Europe at that time. The early immigration patterns in the United States, you had Irish, you had English, you had Germans, you had Scandinavians. But starting in the early 1900s, you started having an influx of immigrants from Europe, Eastern Europe primarily, Russia, Italy, nations like that, and they really changed the dynamics of the American economy and the way society was structured. So you had this huge population of people that were looking for work, needed work, and found work from mostly in factories and things like that. And the last one I touch upon is urbanization, going from a rural society going to a urban society. So what this led to in the progressive era was social reforms and practical businessmen. Everybody knows who Henry Ford was. Henry Ford really created the modern production process, or at least initiated it. Up until then, in the early 1900s, people would buy a car. A car was a luxury item. And it took maybe a day, 2 days to make a car. And Ford recognized early on that with the changes that capitalism and industrialization were making in the United States, in order for a business to thrive, it had to have a mass market, had to be able to produce more products and get those products into more hands. And Ford was primarily a mechanic, and that's how he thought. He wanted to sell more cars to more people. So he created, through the production processes, and they get down to where they could create a car every 12 hours, they created the Model T. And Ford also started paying his workers a better wage than what people in factories were making at that time. So $5 a day was a lot of money back then. Not much in our minds, but at that time it was a decent wage for a working man and woman to make. Now with Ford, you could buy a Model T in any color so long as it was black. You know, that was part of his idea, was you have one simple car that anybody could buy. That started to change with General Motors, and there was a fellow named William Durant who was a salesman who basically came up with the idea of dealerships across the country, and General Motors created a financial arm, the General Motors Acceptance Corporation, GMAC, to make loans initially to dealerships, so the dealers would buy the cars from the manufacturer, and then the consumers eventually would buy the car from the dealership. That was a whole way of doing business that was different from anything that was ever done in the past. Now, Edward Filene, or Filene, because that's how the family actually pronounces the name. We all say Filene, but Filene was a merchandising genius, and his father had started a store in Boston called William Filene and Sons. And when he died, I think around 1875, 1880, his two sons, Edward and Lincoln Filene, were the ones that took over the family store, and they were merchandising geniuses, but they were social revolutionaries because they were the first to really stop paying their workers a decent working wage, because they felt that in order to have a successful business, you needed to have a workforce that was happy, was willing to work at the wage, because working in a store, working in a factory, it's a lot different than you worked on a farm. You had complete control of everything you did. Now you're working on a particular machine all day long. It's pretty dull, pretty boring work, and there's a lot of turnover. So by paying a decent wage, people were more willing to stay and tolerate the boredom of working in a factory. So anyways, Filene also believed that as a businessman, because he was a businessman, a practical businessman, that in order to sell merchandise, you needed to have a population of workers that could buy that merchandise. And so Filene was one of the first people to ever get behind the idea of a minimum wage paid to workers, health care, all that type of stuff. And Filene was truly a revolutionary. And that's how in history books he's treated, as a man that was a revolutionary. Not just a business guy, but a guy whose ideas were so different from that time that he could truly be called a revolutionary. There was a growing need for credit, because in order to sell products and services, people have to have money to do that. And at that time, personal credit really didn't exist except for loans made by family members. There were small societies that were primarily based upon ethnic communities, would make loans to people within their community. But there were laws that prevented personal loans from charging interest rates. There were usury laws. And so it wasn't profitable to make a loan. And having credit was viewed by society as not a good thing. Something was wrong with you morally if you had credit. But now you had, because of industrialization and immigration and growing population and urbanization, people actually working in these companies that produce these mass products and services, you had to find a way to get those products and services into more hands. So there was a push by the progressive reformers, including Filene, to raise legal interest rates and allow profits be made off of loans. And the interest rates were raised, but eventually they were capped. And for many, many years, you could only make a loan at a certain amount from a legitimate bank or a credit union, And I remember the removal of some of the regulations back in the late 70s, the 80s, that kind of lifted those caps. I think for a lot of years, credit unions were limited to a loan couldn't be more than 12%. And Wes, I'm going to ask you if that was correct. Am I right about that, or is that right? That's wrong? So they had to lift the interest rate caps. Reformers moved personal debt from the margin of capitalism to a center alongside commercial and national debt. And there's a great book that came out a year or two ago called Borrow, The American Way of Debt by a fellow named Louise Herron, H-Y-M-A-N. And he talks about how debt evolved into not just being a service, but actually being a profit center for businesses. And consumer debt helped drive that. And credit unions were part of doing that, driving consumer debt, becoming an acceptable way to buy products and services. Early on, there was installment credit, you know, where you would buy basically put money like on layaway, or you'd buy on an installment plan, you buy a car, and you'd make multiple payments over, of course, a period of time. For the first time ever, the working man, the working woman didn't have to get access to capital because of what they had for assets, because they didn't have any assets. It was based upon their income, what they were being paid to earn, and credit became something that was associated with the expectation of money coming into the household. So you were granted credit with the idea that eventually you could repay that credit. So income, personal income, became a real incentive for people to borrow and for companies like credit unions and businesses to actually make loans to consumers. Personal loans relied on income instead of assets repayment, and workers didn't have assets, but they paid like clockwork. Every worker got paid, whether it was weekly, twice a month, monthly, whatever it was. There was a paycheck coming in. So this is kind of the backdrop for the evolution of credit unions in North America. And this picture here is Alphonse Deja, who is obviously, you know, from Quebec, from Canada, was really the man that brought credit unions into North America and founded the first credit unions in Quebec that were called Caisse Populaires, the People's Banks, and they served the working people of Quebec. And today, people look at the Desjardins credit union movement and they see a massive success because the Desjardins brand, at least within the province of Quebec, has a 70% or greater market share. So he was asked to come down to the United States by Faline and some people in New Hampshire to create the first credit union in America, and that was St. Mary's People's Bank, which is still in existence today as a credit union in Manchester, New Hampshire. It was designed to serve the working immigrants of Manchester. Now, if you've been to Manchester, New Hampshire, it's no longer a manufacturing center. But those old mills are still up and they exist. And today they're luxury apartments and condominiums and department stores and all that type of stuff. But that was the population that was going to be served by St. Mary's People's Bank. Now, there wasn't a credit union law that allowed that to happen. So the New Hampshire legislature actually had to pass a special act to create this one credit union. And there's a picture here, an artist's rendition of the house that the credit union was located in, which today is where the Credit Union Museum of America is located. And at the ACUL summer meeting this past July, there was a reception at the museum. So we all drove up from Boston to Manchester. It's about an hour, 90-minute drive at the most. Had a reception, and that's where the museum is located, right in the actual building, right down the street from where the headquarters are for St. Mary's People's Bank. That led to the first credit union state law, which was created in Massachusetts in 1909, and Pierre Jay was the banking commissioner of Massachusetts, and he wanted credit unions to be established in that state, but they needed to have a law to do that. So Faline got involved with that. They brought Desjardins down to help write that law, and that led to the passage of the first credit union law in the United States. And that also led to Faline starting to put more of his own personal money into the development of credit unions. Faline was a philanthropist, and he had created something called the 20th Century Fund, which was a foundation. And today, I think that the actual dollars he spent to create credit unions is about $1 million value at that time. I don't know what the inflationary value of that $1 million from the early 1900s would be today, but it'd be substantial. So he put a lot of his own personal wealth into the creation of credit unions. And he founded the Credit Union National Extension Bureau in Boston, Massachusetts, which was in existence from 1921 to 1934 when the Federal Credit Union Act became law, and that was the year that CUNA was chartered. But Faline hired an attorney from Vermont named Roy Bergengren in 1921. And the goal of the Credit Union National Extension Bureau was to establish laws in every state and also to lobby for the creation of a federal law. To create sustainable state leagues. That was the model that led to the three-tiered credit union system as we know it today. We had pioneers, we had reformers out in every state trying to pass state laws and creating state leagues to form credit unions. And that was the evolution of the three-tier credit union system that we still have. They also began publishing The Bridge in 1924. And The Bridge is actually Credit Union Magazine. That was the first name for Credit Union Magazine. And it was a monthly newsletter. So the magazine itself actually precedes CUNA and was part of the very early part of the credit union system in the U.S. And then Bergingen called what credit unions were doing a crusade. He actually, his autobiography was written in the early 1950s or late 1940s, I forget now. It was after he was no longer with CUNA. He titled it Crusade because that's the kind of passion he felt that credit union people had for trying to bring credit and bring thrift to people that didn't have it before, the average man and woman who are working people. And down below there you see there's a picture of a Bergingen there, and there are three cartoons briefly shown here. They're kind of cut off a little bit. The one on the left is shows the credit union as a Revolutionary War soldier on guard, and if the full picture was there, you would see he's guarding a house, the credit union member's house. He's guarding it from loan sharks, and he's guarding it from other predatory people that might, and as well as sickness and illness, because if you were a working person and you got sick, and chances are if you had bills, there's a good chance you'd never be able to pay those bills. You might lose everything you had. That was the reality of living at that time. The other picture there is a credit union member swimming in shark-infested waters. And the last one is the famous Little Man with the Umbrella, which was created by the political cartoonist they hired to do this, and he worked for them throughout the 1920s. It was a fellow named Joe Stern. So that's the little man under the umbrella being the credit union member, and the credit union being the umbrella that is sheltering the member from all the various afflictions that could affect their financial situation. That led up to the Great Depression and New Deal. So by the time the Federal Credit Union Act was passed in 1934, Feline and Bergingen had been successful through the activities of the National Credit Union Extension Bureau to actually have 39 state laws, and I forget the number of credit unions, but they numbered in the low thousands. But they were successful, bit by bit by bit. Now, if you read some of the history of some of these guys that went around different states to start credit unions, you know, I think it was Thomas Doig, who was one of the founders, and there's a picture of him here too, coming up. But Doig talked about being shadowed by bankers when he would go from town to town to town, because bankers had such distrust of what they were trying to do with credit unions and what they might mean for their businesses, that they actually felt they had to keep an eye on these guys, these revolutionaries, these punk credit union guys. That was a reality that they lived with at the time. So the Great Depression, and if you know your history, you know that the Great Depression was the worst economic disaster to hit not just the United States, but hit basically the world. The whole world went into the Depression. In the United States, unemployment was around 25%, higher than it's ever been at any time since. And I got some pictures here that I like to put up about the Depression that shows what the conditions of the times were. The first one here is a shot of the Dust Bowl, one of the great dust storms that occurred in the 1930s down in Oklahoma, Texas, and Kansas, because without having the safe, environmentally sound farming practices we had today, they didn't know as much about that stuff as we do today. And so what they did is they stripped, 2 million years worth of buffalo grass off the prairies and the farm. And that led to erosion. It led to, when there was finally a massive drought, and that's a very windy area of the country anyways, it led to these massive dust storms that were an ecological disaster in the United States, and led to the migration of several million people out of that Dust Bowl area, mostly to California, but lots of different places to find another way of making life, because people would be caught, they would be found 10 feet from their door, like in a major snowstorm, buried in snow, but they'd be buried in sand. And there were also health issues related to that as well, because sand would get into the lungs of little children, they would develop an illness from that, and they would pass on. So the second picture I have here is one of my favorites. This is, it's called the Migrant Mother, and was taken by a woman named Dorothea Lange, who was hired by the Roosevelt administration during the 1930s to go out and basically photograph the conditions that working people were faced with at that time. And she was in California. This was a family that had migrated from Oklahoma to California, And she came across this woman and her children in this basically not a very good tent, holes in it and everything else, sitting on the side of a roadside, and there was a car up on a jack, and the car was broken down. And her husband had gone into town to try and barter for parts to fix the car. So Dorothea Lange asked for her permission, and she was able to take a number of pictures, and this is the most famous one she took. And you see, you know, the woman's children are kind of hiding in her arms because they were shy. But that picture got great exposure throughout the world because of her efforts, and that kind of symbolizes, it kind of captures the distress that people would have living through something like a depression. The next picture is people lost homes, they were evicted from their land. This is a shanty in the little communities that sprang up across the United States called Hoovervilles, because when the Depression first started, Herbert Hoover was the President of the United States. And so that's a shanty from one of the Hoovervilles. This, of course, is, if you recognize that fellow, that's Jane Fonda's dad, Henry Fonda. And this is from the film The Grapes of Wrath, where this is a family of people from Oklahoma moving out to California. It was based on a great novel by John Steinbeck, The Grapes of Wrath, again, which captured and exposed people to the conditions that average working men and women and farmers were facing because of the Depression. This is kind of an ironic photograph. It shows people in a bread line, and they're standing before a billboard that says, "World's Highest Standard of Living." You know, I mean, you want to talk about irony, that's about as good a picture as you can get. And this last picture is the eviction of World War I veterans from the mall in Washington, D.C., where they were promised bonus money at the end of World War I. Not immediately, but the payments were made some point down the line. And those payments had never been made. And they were veterans, and they needed that money to live. So by the thousands, they went and camped on the mall in Washington, D.C. until they were ordered by, I think, it might have been Roosevelt, I think it might have still been Hoover, ordered to be evicted. So they were forcibly evicted by the police and by the Army. And Douglas MacArthur was the general who actually led that eviction, and Dwight Eisenhower was one of his aides. And Eisenhower always hated the fact that he was involved in having done that. But that's kind of the types of things that people were dealing with at the time that helped lead to the creation of more credit unions. So that, now you had this growing ability among not just the general populace, but also among people in Congress, that, you know, there really was a need for additional financial reform. Now, of course, the New Deal had all sorts of reforms that came out that related to the financial services industry. During the Great Depression, the New Deal, the Security and Exchange Commission was created to govern, you know, the stock market and the trade of equities. The Federal Deposit Insurance Corporation was created to provide depository insurance to depositors and banks. There was a number of those types of reforms, and one of them was the Federal Credit Union Act. Actually, a federal law empowering credit unions, which banks did not like that idea very much because they could see what credit unions could take away from whatever consumer business they were developing. So the law was passed in 1934 and CUNA was formed. And I'm sure you've all seen this famous photograph right here. This is Estes Park, Colorado. Filene's in the front row there somewhere. Bergen is there. I think that's Louise Herron right there. And when I first started working for CUNA in 1977, I was an editor for a credit union magazine, and I used to go to a lot of credit union events and cover them, particularly conferences. And I remember at one conference that was sponsored by, I think it was the Executive Society, the Credit Union Executive Society. And I always sat up front, in part because I had a hearing problem, and it was easier for me to hear, but also because Louise Herron always sat at a table up front when she was still alive. And I wanted to get to know her. And I recall one time in particular when the speaker was a consultant, business consultant, giving advice to credit unions how they could make more money doing, and it was all good advice. There was nothing wrong with what he was saying, but it was kind of, didn't really touch upon the original purpose of credit unions. And Louise Herron stood up and she said, "I want to know who's going to make the loan to the working man whose dentures are broke." You know, they're small loans, microfinance loans, really. And I've always remembered that, and I've always remembered that when I think about what credit unions are supposed to be doing today, and whether we continue to serve our mission. So in 1934, CUNA was formed. 1935, CUNA established the CUNA Mutual Society. And this is a book that CUNA Mutual released a few years ago on one of the anniversaries of its history. And I like this picture because the book is called "The Debt Shall Die with the Debtor." In addition to providing insurance for credit unions to protect the credit union, protect their officers, their board of directors, that type of thing, their big bread and butter product, and still is very much a bread and butter product today, was credit life and credit disability insurance. So a working person could take out a loan. If that person was disabled permanently or died, you know, rather than that loan having to be paid back by that person's widow or widower or their children, you know, they had insurance to cover that debt. Now, consumer advocates for years railed about products like credit life and credit disability because they thought the amount of premiums collected for the paybacks made it a horrible product. It wasn't a good buy for consumers, except the one exception always was the products offered by CUNA Mutual. And the advocates, consumer advocates, almost uniformly believed that those particular products, you know, were an exceptional buy for credit union members. And they're still a good part of what credit unions do today and a good revenue stream for CUNA Mutual. And then there's Dora Maxwell to the left, and there's this Thomas Doig to the right. Thomas Doig actually eventually became managing director of CUNA after Bergengren left. One of the stories that they tell about Louise Herron that her family tells is that she was such a young woman when she first got involved in credit unions, and she was sent to Estes Park to represent Ohio credit union pioneers. And she was maybe early 20s, mid 20s, and of course, you know, in the 1920s, 1930s, you know, women had a certain role to perform for society. They really weren't considered to be business people. And she got to know Filene because a lot of people were kind of gossiping about, well, what's this young girl doing here? She doesn't know what she's talking about. She had a chance to sit down with Filene in his private railroad car and actually have a few drinks with him. And he ended up walking away with a great deal of respect for the intelligence of Louise Herron. But she's a very interesting person. Her son, Bill, was on our board of directors for a lot of years, is still running credit unions in Ohio, a wonderful guy. 1960s to the 1970s, a decade of empowerment and autonomy. The number of credit unions peaked at 23,000 in 1969. I think when I joined CUNA in 1977, there were still like 20,000 credit unions, but they started to decline in numbers at that time. The consolidation, mergers, that type of thing. Credit Union Magazine's circulation at one time was as high as 75,000, you know, compared to the 10 or 12,000 paid subscribers we have today. So consolidation began that continued today, and there were fewer institutions, but the credit unions that existed were of greater size, and they were serving more and more Americans. Now, because they were getting bigger and they were serving more people, Congress finally was convinced by CUNA that credit unions ought to have their own independent regulatory agency. Until then, there had been a bureau of credit unions that had been housed in different federal agencies. I think they started in the Department of Agriculture. They led eventually to the Federal Trade Commission, but credit unions didn't have their own regulatory body, and that was a huge win for the credit union movement in the late 1960s. So the National Credit Union Administration replaces the Federal Bureau of Credit Unions that was in the Treasury Department. And then, because credit unions had deposits like banks had, credit union deposits were not insured. The FDIC did not cover credit union deposits. So they needed a depository fund, an insurance fund, and they created the National Credit Union Share Insurance Fund, which was a big deal. And then the time I came on board at CUNA, share drafts had just been authorized. And up until then, credit unions didn't offer checking or share drafts. They basically were savings and a loan. You had money, you invested, you could go in and get a car loan or some other kind of loan, not even a mortgage usually. But they did not have that important transaction account that's called the checking account. And so share drafts were authorized in the 1970s, and that really created a big brouhaha among the banking community. And oh my God, you know, now they're really these socialists, these communists, and that's what a lot of people would call credit unions, socialistic and communistic. You know, they're going to try and take over the financial system. So now I want to get back a little bit here on the 100-year war waged by banks. So I've gone through some history here. Basically, this is what the banking industry has fought from day one. They fought the initial formation of credit unions. They fought the Federal Credit Union Act. They fought the creation of NCUA. They fought the creation of the Share Insurance Fund. They fought the ability of credit unions to offer share drafts and checking. They fought the ability of credit unions to become full-service financial institutions offering credit cards, mortgages, and all other types of services. And they fought the ability of credit unions to serve more Americans through select employee groups. And always they fought the credit union tax exemption as they're currently doing today. Now, I want to talk a little bit about the 1980s because that led to the major lawsuit against credit unions that resulted in the Credit Union Membership Act being passed in the mid-1990s, and probably the biggest legislative victory that CUNA has achieved and that leagues have achieved in the last 40 years. And in the 1980s, deregulation of the financial services industry created new product offerings like share drafts, individual retirement accounts, plus a rate on saving accounts was removed. It used to be that if you opened up a savings account in a bank or a savings and loan or a credit union, they could only pay so much interest on that. And I think that was Regulation Q, was the name of the regulation that was removed, so they could stop paying more on deposits. Up until then, you know, you would see advertisements and get people to come into a place and open up an account, and they would offer things like China or, you know, toasters, things like that. That was a way to get people into an account, into an institution, and open up an account. Now, I actually knew a guy whose family business was based on that. He was a college roommate of my brother's at Wisconsin here. His father had started that business. They did very, very well. And I used to see him advertising his wares at the governmental affairs conference, the CUNA meetings, where you'd walk in and he'd have, you know, his booth be filled with all sorts of dishware and other types of things because, you know, people are still being attracted by that type of service. And they continued doing that for a while when they did branch openings, as opposed to just trying to get new members into the main institution. So, you know, that was going on. And in 1982, it's a big year for credit unions because that was the year that Edward Callahan, and you guys all know Callahan Associates and creditunions.com, the consulting group that serves so many credit unions, was founded by Edward Callahan and Chip Filson. And Chip Filson, I think, is the sole owner today and is still their head guy. But in the early 1980s, there was a major recession, one of the worst recessions going back to the Great Depression. Not as bad as the recession we just went through, but a bad recession nevertheless. And you know, a lot of major industries that sponsored credit unions were being affected by that recession, and they were closing down plants, they were closing down, you know, different locations, and then the military was going through a reconsolidation as well. So you had the closure of a number of defense bases, military bases, and of course we have in our family the Defense Credit Union Council, which at one time was really a big deal because so many credit unions, some of the large ones in particular, really were military type credit unions. They served like Navy Federal today. So, you know, those credit unions were beginning to suffer. And Ed Callahan, who was a Reagan appointee, had a belief that if the Federal Credit Union Act did not say you couldn't do something, then that meant you could do something. And up until then, credit unions were known for serving primarily a single common bond. And you got into a credit union through the workplace, right? You know, you joined up, you paid, like I joined a credit union here, my first credit union at CUNA. You know, I was sitting at my desk in 1977, you know, 25-year-old guy who looked like he just came off the boat. Didn't dress very well. I still don't actually, but that's another story. And Vera Kroner was the branch manager for CUNA Credit Union. And she was a little woman, spoke with a very, very thick German accent. And she had a little office in Feline House on Sherman Avenue. And when you first started working for CUNA, at that time, CUNA required its employees to be members of credit unions. So Vera would come around and she would sign people up for credit union membership. And then we'd have a line outside her little office on payday where we would cash our checks. You know, and she would have a little cash deposit, cash box, and she would cash our checks. And I remember we had an economist at that time, one of Bill Hampel's predecessors, and you know, he wanted to withdraw some funds from the credit union, and she wouldn't let him do it. Well, eventually she did. She had no choice. But we're all standing in line, you know, waiting to cash our checks. So we hear this economist arguing with this little German woman. And the reason she didn't want him to withdraw his funds was because, you know, the credit union hadn't declared his quarterly dividend at that time. And she felt that he would be, you know, shorting himself of money. But he actually got mad. It was a shouting match. But that's a different world, right? And that's what credit unions in a lot of respects were. But now you had credit unions needing to serve more employee groups. And there were credit unions that served communities or parish or a church congregation that was more than just a working common bond. But the vast majority of credit unions served people that worked in a particular business. And what, you know, Ed Callahan said is, no, well, you know, as long as they're serving another group of employees, they also have a common bond. You know, you can serve multiple employee groups. One of the things that was going on in the United States at that time and continuing today is that most job growth does not occur in major businesses. Most job growth in the United States occurs in small businesses. You know, it might be a bakery, it might be a print shop, a place that might employ anywhere from 10 to 15, 20, 30, 100 employees, but not large enough to support a credit union in and of itself. Like in the old days, we'd walk down the street here to Oscar Mayer, the production plant, and Oscar Mayer had a credit union because they had 2,500, 3,000 employees. You know, and that was a dynamic that changed the way credit unions were formed, because you no longer had large businesses, you have small businesses, and so you have to be able to reach those people, you have to be able to serve them. So Ed Callahan allowed credit unions to start serving select employee groups. That led to a lawsuit. 4 North Carolina banks, with the American Bankers Association, filed suit against NCUA and AT&T Family Credit Union over the 1982 interpretation of the Federal Credit Union Act. And AT&T Family Credit Union still exists today, has a different name. I think it's Truliant. Am I right about that? Am I wrong? It's Truliant Credit Union, yeah. Well, that led to a lawsuit, and the lawsuit made its way through all the various levels of our court system until 1998 on February 25th, and this occurred during the Governmental Affairs Conference in Washington, D.C., and I remember being in the main ballroom when the word came down that the Supreme Court had upheld the bank's suit on a 5-4 decision. Basically, the Federal Credit Union Act had to be interpreted to mean a single common bond. Now, CUNA was obviously very, very involved in that and defending credit unions against that particular lawsuit. And we already had, through the efforts of our advocacy group in D.C., we already had proposed legislation ready to go. And Newt Gingrich was the Speaker of the House at that time. And Gingrich always attributed to one of his tough re-election campaigns to credit union support in one particular year. So he was very supportive of credit unions. And unlike most speakers, which I'm not sure if that's still the case today, but up until then, speakers did not generally sign on as a sponsor of legislation. And Newt Gingrich did, and he was the keynoter at the Government Affairs Conference. And I know Newt Gingrich is a very controversial guy today, and a lot of people have different opinions about Newt Gingrich, but at that time he was really an important proponent of credit unions. And so we introduced legislation in Congress. We already had a number of co-sponsors set up, and you know, we had enough people behind the bill that the bill then could proceed to the various committees in the House and the bank to be debated. And this is where we start getting into the issue of compromise, because we won that battle. And you know, the full House passed H.R. 1151 by a vote of 411 to 8 on July 28th. And the U.S. Senate voted 92 to 6 to allow credit unions to serve select employee groups. And on August 7th, President Clinton signed that bill into law. And we had lots of credit union representatives in his office, Dan Micro at the time, some of the league presidents who were so integral in getting that law passed. But what people don't realize is that to get that bill through Congress was not as easy as it initially appeared, because all bills that get to the floor for a final vote have to go through a committee. And oftentimes it's behind the scenes in those committees where the major battle is fought. And in both the Senate Banking Committee and the House Financial Services Committee, our legislation got through committees by a single vote, in both cases, by a single vote. And if we hadn't made some compromises at that time, that legislation would not have gone through committee. Alphonse Deja was a Republican senator from the state of New York at that time and was chairman of the Senate Banking Committee and a huge proponent of credit unions. It was his decisive vote cast in the Senate Banking Committee that got that legislation out of the committee and onto the floor of the Senate for passage. So the compromises we made, there were 2 major ones. One was prompt corrective action, which is basically if a credit union's capital dropped below a certain percent, there's certain things that had to be done. That wasn't in place before this legislation passed, H.R. 1151 in the late 1990s. And then there was a cap put on credit union business loans to members. Credit unions had always made loans, business loans, and agricultural credit unions, that basically was the heart of their business, making loans to farmers. And they were grandfathered. They were grandfathered. About 25 credit unions that had enough member business lending at that time where they were grandfathered from having the cap apply to them. Most other credit unions didn't have anywhere near the number of member business loans where they could get up to the 25% of assets. That's 12.25%, whatever it is, of the assets that can be lent out in member business loans. So, but a lot of credit unions realize there'd be another battle coming down the road. And obviously, if you pay attention to what CUNA is doing in D.C., this year, obviously, because of the rewriting, the possible rewriting of the federal tax code, that's taking precedent. But the last year, the previous Congress, trying to lift that cap on member business lending was one of our primary legislative objectives. So we made a compromise. We made 2 compromises to get that membership act through Congress. If we hadn't made those compromises, you know, you could seriously ask yourself, where would credit unions be today? Because banks had won at the court level to restrict credit union membership. And not just restrict credit union membership, but people that currently belong to credit unions at that time, through these select employee groups, they weren't grandfathered. They would have lost their credit union membership. You know, so it's a big deal, and it's a major piece of legislation. We got to pass. Got to pass because we are people. We're men, women. We're not angels, and we always have to make compromises. I want to talk a little bit now. Just switch gears in just a few seconds here, a few minutes. Talk about you know, the absurdity of the bank argument about what credit unions do and the threat that they make. You know, the first U.S., I mean, bankers claim credit unions are empire builders. Now, this comes from some of the data that CUNA has put out on the website, CUNA.org, for Don't Tax My Credit Union. Assets in credit unions grew to $1.3 trillion by year-end last year. It took 104 years for credit unions to grow to a total of 1.3 trillion assets, or 1.03 trillion assets. In contrast, the U.S. banking institution assets grew by over half this much, $559 billion in 1 year alone. 1 year alone. It took us 100 years to get to $1 trillion in assets. Overall, 4 banking institutions, JP Morgan Chase, Bank of America, Citibank, and Wells Fargo, are larger than the entire credit union industry. And I'll go back to that NCUA bracket slide that I showed earlier, where you can see that massive consolidation of banking institutions down to the top 4 or 5 that exist today that are really the national banks that are threats to credit unions and community banks in terms of business. And each of these banking behemoths controls total assets exceeding $1.25 trillion. So each one of these individual banks has assets that are greater than all the credit union assets in the United States of America. They claim that credit unions are getting too big. As of year-end 2012, banking institutions held over 14 times more assets than credit unions, 14.45 trillion to our 1 trillion. Each of the nation's 4 banking entities, I just said this, are larger than the entire credit union movement. The average banking institution is over 14 times larger than the average credit union, $2 billion compared to $148 million in assets. At the year-end of 2012, one half, the median asset size of a credit union in the United States, so one half of credit unions are greater than this asset size, one half of credit unions are less than that asset size. The median asset size was 20, what do I have here? I lost my place here, but $21 million. Overall, less than 2% of banking institutions are this small. Overall, 60% of banking institutions had $100 million or more in total assets at year-end by 2012. Only 20% of credit unions are this large. Now, this is actually some charts, a couple of charts that show who has what kind of market shares. And this is share of U.S. deposits in 2010. And you can see who threatens who. Last chart I think I have on this particular thing. This goes to show too big to make money. Profits of the top U.S. banks by assets with and without taxpayer subsidy. Actually, taxpayers to this day, because of the bank bailouts back in 2008 and 2009, we're still subsidizing banks to the tune of $86 billion a year. So when banks say they want credit unions to be taxed because we're a rip-off the American taxpayer, and we don't have any economists in this room, and I forget the actual number. You know, John, maybe you know it. I don't know. What is the tax subsidy for credit unions? What's the amount for that? It's not that much. I think it's well below the $86 billion a year that each of these banks is being subsidized to.
I think it was $8 billion.
8 billion?
Yeah.
Okay, $8 billion. So you can see, we're not comparing apples to apples here. We're comparing massive pumpkins to cherries, you know. And again, this is a profit margin. You know, you can see these are banks that are being subsidized to this day. So who threatens whom? You know, the largest 100 banks grew from 41% to 74% of market share. All other banks shrank from 53% to 19% of market share. Those are the community banks. All the banks that say that the threats coming from credit unions. Credit unions grew in, 20 years. Credit unions grew from 5.6% of financial assets to 6.7% today. So who threatens whom? So what is the benefit of credit unions to members? Because obviously if you tax credit unions, that means credit unions inevitably are going to have to adjust to that taxation. They're going to do that by raising their loan rates, probably paying a little less on deposit rates. And right now, look at the overall benefit for credit union membership nationally in the United States is $6 billion annually. So consumers that are members of credit unions are saving $6 billion a year by being members of credit unions as opposed to doing their work with banks. That's $121 per member household. Now that may not seem like a lot, but when you realize that most people who are anti-tax people in the United States today get worked up if they have to pay an extra $50 in taxes. $121 per member household is a lot of money. The argument here being that if you tax credit unions, you are in essence taxing their consumer members. So it's a tax increase on them. And that $6 billion annually, it's been a larger amount in past years. The reason why it's only $6 billion today is because interest rates are so low today that what they pay, what we have to pay for loans, our mortgages, whatever loans we take out, is much lower today than it was a few years ago. If interest rates begin to rise again, that number, $6 billion annually, will increase as well. So this is the last slide I have, and this is the end of my presentation. And I spent an hour. I'm supposed to cut it down to 30 minutes for Kentucky. That's going to be a challenge. Anyways, the potentialities, I got three quotes here from Roy Berginger's book, Crusade. The potentialities of the credit union movement are even more important than its accomplishments. Now, he wrote that around 1950, but that still holds true today. That's why what we are is as important to the American society, the American consumer today, as it was in 1908 when St. Mary's was founded, and in 1909 when the first Credit Union Act was founded in the state. The credit union should eventually reach all men and women whose life can be improved. All. Not limited to people in this common bond or that common bond. Every American ought to have the opportunity to join a credit union. And political democracy can be most securely buttressed by economic democracy. And this resonates with me because I passionately believe that the great American middle class that was created following the Great Recession and up through the 1970s when things started to change with work, types of jobs that people had, that type of thing, that we've had a marvelous multiple decades of great economic stability. Yeah, we've had issues. We've had, you go back to the 60s, you had race riots. You go back to, you had Occupy Wall Street a couple of years ago. But the fact of the matter is economic democracy protects our political democracy. And if you take that away, and with some of the stuff we're seeing today with the makeup of the economy, the types of jobs that are available, 75% of all jobs have been recreated since the end of the Great Recession a couple of years ago. 75% of those jobs have been low-wage jobs. Half the jobs that were lost during the recession were middle-wage jobs. So you have a burgeoning population of people who are working poor, normal working American men and women, and that's why credit unions are still so important today. The fact that in the 1990s, you had a few hundred, maybe a few thousand fringe bankers, payday lenders, check cashing outlets, that type of thing. They sprang up by leaps and bounds to the point where in the 1990s they ended up having more than 20,000 storefronts. And I would say that that's partly because the people behind that industry realized long before anybody else did that there was a growing population of working Americans who did not have traditional financial services from a traditional institution, and they could be served through these alternative solutions. And that's why credit unions today are as important now as we ever have been ever. And that's why the importance of fighting this tax battle is important today as it was when banks first objected to the first credit unions being formed. So that's my story, and I'm sticking with it. That's my last speech for CUNA. I'm done.